Welcome to video 3. In this video, we will cover secondary market trading, types of orders, what are the different types of orders in secondary markets when the traders trade, and what are the pros and cons of these different. Now coming to different types of order options available in secondary markets, first of all comes market order. Market order is the simplest type of order in market. An order is executed at the best price available in market. If more buy and sell orders reach market at same time, the order with the best price is always given a priority. So in this instance, if buyers are coming and offering or inputting orders, then buyers offering higher price are given priority over those offering lower price. And similarly, sellers, whoever are asking a lower price, are given a priority over those sellers who are asking for a higher price. Now if there are more than one orders at same price, then the priority of these orders is based on the time of arrival. So whichever order has entered into the exchange or the market earlier will always be given priority over the order if both the orders have same price. Now coming to limit order. Limit order is an order in which the order is executed only at a specified price, unlike market order, which can be executed just by having the opposite side of order available in market. A limit order designates a price threshold for the execution of a trade. So in this way it is a conditional order. Condition saying that the price should match with the whatever price mentioned on the order should match with the opposite side of the order. A buy limit order indicates that security can be purchased only at the designated price or at a lower price which should be within the spread of that order. A sell limit order indicates that the security can be sold at a designated price mentioned in the order or a bit higher within the spread. Coming to stop order. The agenda of stop order is to reduce loss in case the market keeps on moving towards a certain direction. It can be upward, it can be downward. So depending on the trading strategy, a stop order is helped to reduce the loss which can happen due to continuous movement of market. Stop order specifies that order is not to be executed until the market moves to a designated price, which is your stop loss price, after which it simply becomes a market order and gets start executing. A stop order to buy specifies that order is not to be executed until the market rises to a designated price. Similarly, a stop order to sell specifies that the order is not to be executed until market price falls below a designated price. Now for an example, if we take a company XYZ which has bought 1000 shares of ABC Corporation at $45 last month. Today the shares are trading at $70, but the organization who has bought the shares now feels that the shares are overpriced and they may fall down to 50 in next 2 months. So to avoid losing the unrealized gains, which is $25 per share they have already in profit, they put a stop loss at $68. So in case the price starts to fall down at and reaches $68, then they sell all the shares at $68 and thus safeguarding themselves from share prices falling till 50. Now coming to market if touched orders. This order becomes a market order if the price of the security in the market reaches a designated price. However, a market if touched order to buy becomes a market order if the market goes down to that designated price. A market if touch order to sell becomes a market order if market rises to a specified price. Now it sounds similar to a stop loss order, but the difference here is this is a speculative order to make gains, whereas a stop loss order is an order to mitigate or reduce the losses which can happen due to market movement. So market if touched orders is speculatively you are trying to make gains from the moving market, while stop loss you are trying to reduce your loss. Good till orders. Good till orders are such orders which are valid till some specified date or some specified condition or cancellation. So there are two types of good till date orders. The orders which are valid till some specified date, those are called good till date or GTD orders. And the orders which are valid, which remains valid till they are specifically cancelled or get fully executed, are good till cancel orders. Now the good till orders, the benefit about them is that they remain live in the market matching that particular condition. So a good till order can be a mix of a market order, limit order, and also be a good till order, good till date. So if you see, so an intraday order is a good till date order, but it has a good till date as today only. So whatever gets executed in a good till date order as an intraday till today, rest of the order stands cancelled. Now coming to size orders. For common stock, orders are also classified by their size. Usually shares are always traded in a lot. A lot can be a lot of 10, it can be a lot of 100, it can be a lot of 500, depending on type of security, the company's evaluation, market evaluation, and many other things. So exchange decides whether a security needs to be traded in a lot of 10, 20, 50 or whatever. So now what we call a round lot is when it is a exact multiple of the lot size. So let's say if for a security, if the lot size is 10, then if you are trading in a shape of 20, 30, 40 or 100, which is a multiple of 10, then it's a round lot or normal lot trading. In case for same shares you want to trade less than 10 shares where the lot size is 10, then it becomes an odd lot order. Then there is a block trading. In block trading, whenever an organization trying to buy or sell shares feels that okay, they have too much shares to buy and sell in one single lot and that may impact the market prices, then they may try to do a block trading with the opposite side of the business. Also, different exchanges provide some regulations regarding the block trading. So there can be a regulation regarding a trading or a block trade becoming valid only if its value is more than 100,000 or the trading number of securities is more than 1 million or something. That depends on exchange. So basically when we call a size related order, we can always send orders either in normal lot or odd lot or block trading. It means that if there is a lot size of 10 for a particular security, you cannot send in market an order of 26 shares. It gets rejected by exchange. So in this case, and you have 26 shares only, what you do is that you send a normal lot size order of 20 shares in market and send a separate order as 6 shares as odd lot. Now coming to pros and cons of these different order types. Number 1, market order. As we know, market order is order executed at market price. So whenever a client is sending an order to buy, let's say 1000 shares as market order, then whatever is the available quantity at whatever price, we get execution of 1000 shares. This is a big pros of market order, that a client can get maximum execution available in market at whatever price. The con, however, is that adverse price move can happen in market between the time the investor places the order and the time order is executed. So if there is a sudden change in the market price, so the actual execution or the strategic behind the execution may get impacted. Now limit order. Limit order is always executed at expected price. So the pros is that if a client is strategizing to buy a particular security or shares at one particular price, limit order will help them do that. However, the same thing can be a con, that if the matching price does not become available the entire day for that particular order, Nothing will get executed in such kind of a limit order. Now stop orders pros are it reduces loss amount in scenario of security prices upward continuous movement or downward continuous movement, thus mitigating or reducing the loss a client can have. However, the con behind a stop order is that an abrupt price change may cause execution at incorrect price, and there is always a uncertainty of execution as stop order because it is a market order whenever the price is triggered. Coming to market if touched order. So whenever the price is reached, the trigger price, the order gets executed at market price. So thus the pros about market if touch order is that it helps in maximum execution near to the trigger price, since order is always executed at market price once the trigger price is reached. Similar to stop order, the con of market if touch order is same, that there is an abrupt price change once the trigger price is reached, then it can cause execution at very unexpected prices as well. However, that scenarios usually happen rarely. Good till orders have a pros that order can keep on executing till it is executed completely, or the cancellation condition triggers, or the date has arrived for its expiry. Now good till orders are good for clients because it helps clients in long-term strategizing. For example, if a client wants to buy 1 million shares of one particular security, then it may not be possible to get 1 million shares always. So in such a scenario, whatever gets executed first day, the remaining unexecuted quantity becomes a live order next day, thus keeping on repeating itself and getting either finally executed completely. So client gets either 1 million shares or client can cancel whenever they want. However, the con of a good till order is that it needs to be replayed into the exchange or into the market with whatever is the unexecuted quantity left on that particular order, because exchange cancels all orders in its system post market cutoff. So whoever is the broker who is trying to execute such good till orders for the client, they need to replace such orders for the remaining unexecuted quantity on exchange next day as well. Now coming to size orders. Orders can be executed as per available shares with the clients or whatever you are holding. It can be executed in a normal lot, or if you are having less than the lot amount of shares in the odd lot, or if you are having too many of huge quantity of shares and you want to trade one altogether, then you can do it in a block lot. Now the con behind lot sizing or size order is that your order size should always be in compliance with the exchange regulations or whatever the lot size exchange recommends for a particular security. You cannot send any order size in market as per your liking. We have come to the end of this video. So if you like our video, don't forget to share. You can also subscribe our YouTube channel, which is Capital Markets Easy, or you can drop us your queries on our email, that is capitalmarketseasy@gmail.com. No spaces please. Hope you like these videos. Keep on sending back your queries. Thank you.